Alright, welcome back to another video on the After Hours channel. 9 days ago, I posted this video right here. This undervalued company is printing cash, and I highlighted how I initially made an $8,000 buy into this company. Well, in the span of 9 days, a lot of things happened, and we're going to be taking a look at a few different articles recently published about this company. And not only that, but I'm going to be giving you guys some insights on why I still think this company is a buy and even more attractive than it was 9 days ago. But before we dive into that, let's do a quick portfolio update right here. You guys are looking at my dividend portfolio sitting at $98,000. All time, this portfolio is up 53% or $34,000. If we take a look at the year performance, we can see the portfolio is up 37% or $26,000. Year to date, the portfolio is pretty flat, only up 1%. And in the last 3 months, the portfolio is up over 12% or $11,000. Now, what is the driving force behind these gains? Well, it is my holdings that you see on your screen right here. Listed in order from my weighting size top to bottom, you can see all the companies I hold in this dividend portfolio. And you'll notice out of this list, only one of these companies is in the red right now. That company is none other than United Health Group. Currently down almost 3% for the day. This stock has been going through it the recent weeks. Year to date, we can see this holding is down over 5% alone from near all-time highs. And if we look down here, you can see my total market value of this company. I currently have $12,000 invested in this holding alone. My average buying cost is $532 per share, and it currently makes up over 12% of my portfolio. Now, my average buying is $532 per share, but the company is currently trading at $504 per share. So in my opinion, I think this is a good opportunity to start loading up on some more shares, and let me tell you why. If we take a look at the analyst rating by Morningstar, we can see that 78% say it is a buy, 17% say it's a hold, and 3.6% say it is a sell. If we look down just a bit further, we take a look at the research section, and this is where I really want to direct your attention, and that is the fair value they have for United Health. The fair value they have for it is $520 per share. I think this presents a great opportunity for investors to get into this company. But as always, do not take my word for it. We're going to look at a few different articles highlighting the opportunity with United Health in the market right now, and the first one we're going to be starting with is the 3 most undervalued blue chip stocks to buy in January. As some bonus content out there, if you guys are interested, they also have Wells Fargo and Delta Airlines on here. So if you're an investor in those companies or you're interested, feel free to take a look, but we're going to be focusing our attention on United Health Group. The bullet point they have for this company is the health insurer stock is cheap by historic measures. It says many analysts are talking about the rebound in healthcare stocks for 2024. If that's the case, investors should load up on shares of United Health Group and buy the dip after the company's Q4 results. The largest healthcare insurer in the United States reported Q4 financial results that beat Wall Street's forecast on top and bottom lines. Like Wells Fargo, UNH stock has dropped 3% due to higher than expected utilization rate for medical services. For the final quarter in 2023, United Health reported EPS of $6.16 and revenue of $94.4 billion. That topped consensus forecast that called for earnings of $5.98 a share and revenue of $92.1 billion. Sadly, Wall Street didn't like that United Health said its medical loss ratio for Q4, which tracks the proportion of premiums paid to cover medical expenses, was 85% above the 84% estimate. Now, if that was a bit confusing, let me simplify it for you. The stock price actually dropped because analysts priced in their medical expenses going up by 84% when in fact they went up by 85%. That is a 1% difference, and they beat on all of their other earnings. So all the historic metrics are trending upwards for this company. They missed their estimates for medical expenses by 1%, and that is why we see a huge decline with this company right now. In my opinion, completely unjustified, but let's continue reading this article to give you more information. A higher medical loss ratio is of concern because it means more spending on medical expenses and less room for profits. When we take a look at the financials later, you will see there is plenty of room for profits for this company. The past year has been historically weak for United Health stock, which is up 6% in the last 12 months, trailing the market. That is true. It's actually below that now, 5%, which we looked at earlier. It did have a pretty flat year, and that's why I saw opportunity in the market, because when you compare the financials of this company to some of the larger companies out there like Apple and Microsoft, they are trending in the same direction. The free cash flows, the revenue, the net income, all going up year after year. Trading at 22 times future earnings estimates is also low for the stock, and it pays a quarterly dividend of $1.88 for a yield of about 1.5%. It looks like an undervalued blue chip stock. I really do think investors are missing the mark with this company, and I think it's not correctly priced in right now. Let's take a look at another article, and that's going to be 3 mega cap stocks approaching oversold status. Let's see what their analyst has to say about United Health. It says, despite United Health managing to top analyst expectations for their Q4 earnings earlier this month, their shares have still been coming under pressure. Having come within cents of an all-time high in earlier December, they found themselves down as much as 10% yesterday before recovering in the close. It goes on to say United Health has the highest RSI of the 3 stocks listed here. While it's not technically in oversold territory yet, that doesn't mean there's not a bargain to be had. I agree with that as well. Even though its shares have been softened somewhat in recent weeks, there's still less than 8% move to a new all-time high. When this was written, the company shares were trading at around $520 per share, which is around that Morningstar estimate. Now we're looking at a $504 per share, so much less than when some of these articles were written. The article goes on to say bearish comments from Humana yesterday wouldn't have done them any favors, but if anything, that dip looks like a solid entry opportunity as a result. And as I mentioned in the beginning of this video, I do think this presents a great entry opportunity for not only current investors, but people who are wanting to get into this stock before but thought it was a little bit overpriced. The next article we're going to take a look at is 3 dividend stocks targeting at least 25% upside by 2026. Now that's a pretty bold statement, so let's hear what they have to say. For those of you that don't know, United Health Group is an American multinational health insurance and service company headquartered in Minnesota. They are one of the most compelling dividend stocks with upsides through 2026. The company is closing off a strong 2023 fiscal year thanks to strong double-digit growth at both Optum and United Healthcare. Optum is their pharmaceutical company and United Healthcare is their insurance. United Health Group's revenue grew by 15% year over year to $371 billion. Operating income increased by 13.8% to $32.4 billion as growth continued across all business segments. So again, this is just another article highlighting the fact that all of the financial metrics for this company are trending in the right direction. And not only are they trending in the right direction, but they're increasing by double digits consistently. Last article we're going to take a look at, and that is 3 stocks to turn $1,000 into $10,000 in 10 years. That is a 10x return. Some more bonus content for you guys. It says Peter Lynch coined the term 10 banger to mean investing for 10x returns. Well, hopefully that's the case for United Health. We also have Microsoft and Broadcom on this list. Starting in the second paragraph, the article goes on to say United Health's performance last year fit the bill as its stock was essentially flat. Yet over the past 10 years, it offered investors meaty 22% annualized total returns. A $500 billion market cap opens the possibility of becoming the first healthcare stock to achieve a $1 trillion valuation. United Health can achieve distinction because healthcare is something you can't ignore, at least not for long. Doctor visits, prescription medications, and even emergency services are all essential and in high demand regardless of the economy. The insurer is a perfect safe haven stock for your portfolio and one to create wealth. Its Optum Health Service business remains the primary driver of future growth. Despite the company's performance last year, the segment expanded revenues by 20% or more each quarter. Home health care will also be a key component of United Health's future. Last year, it acquired LHC Group, and this year, it will close its $3.3 billion purchase of Amedisys. It goes on to say when you offer services that people literally can't live without, you have a solid path to long-term growth. And now, after looking at those articles, I just want to give my thoughts on United Health Group and buying stocks that you have conviction in general. After doing all of your research, looking at a balance sheet, looking at the quantitative and qualitative data for a company you're going to buy into, and if you feel comfortable buying a company like you see here at $500 $541 per share, and now it is trading at $503 per share. Why would you not buy more of that company? I constantly reiterate this in most of my videos, and it is leaning into your convictions. This simple addition to my investment strategy has really increased the performance of my portfolio, which resulted in a nearly 50% return for 2023. As you can see, I leaned into my convictions for Microsoft, and I'm up over $10,000 on this company. Not only that, but if we take a look at my Apple holding, I did the same exact thing. I leaned into my convictions. I saw value in the market, and I saw that other investors weren't pricing in the future growth of these companies, and I'm up over $6,500 on Apple. Now, if there were no major changes with the company and the financials only continue to improve, why would I buy in here and not buy in here where it's currently trading? I'm essentially buying the same exact company that I did when it was trading at $540 per share, but now I'm getting a discount and I'm able to buy in at $504 per share. It is not very often you'll see discounts in the market, especially for companies like United Health. When you hear the term compounders, it's not very often you'll actually stumble across one, and I look at United Health as exactly that. A company that can continuously increase their revenues, a company that has continuously increased their free cash flow, a company that has raised their net income over and over again each year, and not only that, but a company that is dedicated to their shareholders by paying an increased dividend multiple times a year. To close this video out, I'll reiterate the term that was coined by Peter Lynch, and that is 10-banger. I look at this company in my portfolio as a 10-banger, a company that can give me 10x returns in 10 years. And as always, if you guys enjoyed the content and you learned anything from this video, consider subscribing, liking the video, and if you have any questions, leave them down in the comment section below. I appreciate you guys watching, and I'll catch you in the next one. Take care.